ABM is spending billions to stop being just a cleaning company. But is the math working? ABM Industries is in the middle of a high-stakes identity shift. They are moving from traditional facility services to critical infrastructure partnership. The latest 10Q reveals a company aggressively chasing high technical markets. Revenue for the quarter hit $2.29 billion, 8.4% increase year over year. This growth is fueled by a 6% organic lift in core aviation and tech. The bull case centers on the explosive growth of their technical solutions segment. We are seeing 20% plus organic growth in battery storage and microgrids. Acquisitions like Uginestar and UMC are accelerating pivot in the semiconductor support. Operating profit grew 5.5% to $86.9 million, showing some operational resilience. The most impressive swing is in the cash flow statement. Operating cash flow for the first half hit $128.2 million. That is a massive $22 million improvement over last year's performance. Management is also executing a restructuring plan to save $35 million annually. But if we look at the bear case, the cracks start to appear. Gross margins actually compressed by 72 basis points this quarter. This suggests that while revenue is growing, the cost of delivery is rising. Labor inflation and a tough contract mix are eating into the profits. Then there is the balance sheet, which is looking increasingly heavy. Long-term borrowings have surged to $1.9 billion, up 24% year over year. Interest expenses have climbed 11% to $28 million this quarter. The revolving credit line is already 86% utilized, leaving little room for error. Goodwill and intangibles now make up over half of the total assets. If these acquisitions don't deliver the promised synergies, impairment risks loom large. The company is also managing Level 3 liabilities for contingent earn-outs. These are unpredictable cash outflows that could hit the balance sheet soon. So, what is the final verdict for the investor? ABM is successfully growing the top line and pivoting toward the future, but they're doing it by taking on significant leverage and risking margins. The key will be whether the $35 million in savings can offset the debt. If they stabilize margins and reduce, an inflection point is real. Until then, it is a high growth story with a heavy price tag. Watch the next quarterly report for signs of margin stabilization.